Hi guys, I'm Dan. This is Kai coming to you from Crescent Mortgages with one of our FAMQs, frequently asked mortgage questions. And today's topic is going to be affordability. So basically, how much can you borrow on a residential mortgage, the different ways that lenders assess this, and giving you an indication of maybe how much you can borrow, or you can at least work it out yourself using the kind of calculations that we give you. We should mention that we are CMAP qualified mortgage and protection advisors with a combined 20 years in the industry. Should we jump into it, Kai?
Let's do it.
Let's do this thing. Affordability. Thinking about it, this is probably pretty much the kind of the main and first topic that we discuss with pretty much everyone, isn't it?
Yeah.
You know,
Yeah, it is, yeah.
With a residential mortgage, you know, regardless of how limited you are with, you know, your the rest of your circumstances and other kind of criteria limitations, it's kind of all irrelevant if you don't meet affordability, if you don't have enough income to borrow the amount that you need. So this is actually a really big one, but hopefully relatively straightforward to kind of explain. I guess the first thing to cover is that when lenders look at affordability, and first what affordability means, because a lot of people actually...
Oh, surely it just means if I can afford it each month, doesn't it?
Well, I mean, that is a factor. You do need to make sure that you are going to be comfortable with the mortgage payment. However, when you hear someone in the mortgage industry talk about affordability, it basically means how much you can borrow. So when the lender runs their affordability assessment, they will come back with a maximum that you can borrow, and that's what we're looking at when we say affordability.
Right, okay.
Now, there are two ways, and they'll use both, that lenders will assess your affordability and if the mortgage is going to be affordable. Yeah. The first one, you can actually jump in there, Kai.
Thanks, mate.
I feel like I was going on a little bit.
Income multiples would be the first one. So I won't explain them yet, we'll go into them. Income multiples would be the first one, the second one would be...
do you want to just elaborate a little bit on income multiples?
You want me to elaborate on income multiples? Okay, so income multiples is a multiple of your income. And it isn't more than that.
Of your annual gross income before tax. Okay, no, that's enough elaboration. We'll come back to that.
You're welcome.
And then the second one is when they assess your month-to-month affordability. So are you going to be able to sustain your mortgage payment along with all of your other bills, commitments, debts, outgoings, food, utilities, all of that kind of stuff, as well as stress testing. So, you know, if interest rates go up, are you still going to be able to afford that? So they're looking at the income multiples and the monthly affordability assessment, and you're going to need to meet both of those assessments for the lender to give you the amount that you want to borrow. So I guess should we start with income multiples? Do you want to elaborate there?
Yeah, income multiples. Okay, so income multiples. So, as Dan mentioned earlier, it is just a simple case of your annual income. And let's keep this one simple to start with. So if you're just looking at your basic income, you earn £50,000 a year.
Before tax.
Yeah, your gross income. They will multiply that by generally at least 4. So it would get you 200,000. Some will go up to 5, so 250,000. And if the income is high enough, sometimes you can get to 5.5 times income. You'll get the odd obscure one that can go higher than that, but I wouldn't factor or base everything on that, and that's a conversation. Maybe.
And even 5.5 is going to be quite difficult for a lot of people. For some people, if you meet the criteria, then it is possible, but a lot of lenders will cap at kind of a maximum of 5. And again, depending on a few other factors, you may not even be able to get to 5 times income. I guess in terms of what will impact the income multiple. So first of all, the lender. So some lenders will just have higher income multiples than others. So in that area, some lenders are more generous than others. So obviously that's why dealing with a broker, they'll be able to kind of explore the entire market rather than if you just go to your own bank, where they may not happen to be the most generous lender when it comes to affordability or income multiples. So there's only an absolute limit that they're going to be able to lend to you regardless of your circumstances. But I guess probably the two main other things that impact the maximum income multiple would be...
your loan to value, so your deposit.
Yeah, or equity if you're remortgaging.
Yeah,
we did cover this in another video, which obviously you can check out our loan to value video. But the better your loan to value, so the lower your loan to value, whether that's a bigger deposit or whether that's just your remortgaging and you've got a lot of equity, that will sometimes improve your income multiples.
What's the other one?
Oh, okay.
Yeah.
The other one is your income. So a lot of lenders, if your income is over £40,000, and that can be a combined household income, if it's over £40,000 or £50,000 or £100,000, depending on the lender, they will sometimes go to a higher income multiple because they're more comfortable that you're going to be able to sustain the mortgage kind of stretch to a higher level. So that's income multiples.
Yep.
If we jump over to the second one, and again, you need to meet both of these. So it's like I say, the monthly affordability assessment. So how are they gonna look at that?
Disposable income. So they're now looking on a month by month basis, I suppose. So as again Dan touched on, they're looking at not just now your income, but they're looking at, right, so what can they actually afford and what have they already got going out? So have you already got commitments each month that we need to factor in? Do you have a car on finance? Do you have a bank loan? Do you have credit cards? Children, and therefore possibly childcare. Loads of things there that come into it. Not just that, I suppose, the mortgage payment itself.
Well, exactly, yeah. So where income multiples just focuses on your income, the monthly kind of affordability assessment will really focus on your income as well as your outgoings, as well as your new mortgage payment. They'll also stress test it based on interest rates going up in the future. So they need to be comfortable that you can afford your mortgage payment plus all of your bills and outgoings, not just now, but let's say in a few years if interest rates went up by 1, 2, 3, 4%. So they're looking at both of those. So I guess an example of this is, just because a lender could technically lend you 5 times income and you fit within the criteria to borrow 5 times your income, if you have kind of significant monthly commitments, let's say you have several debts, let's say you've got a couple of children, you've got childcare costs, then there's actually a fair chance that when they start to factor that in, you can no longer borrow the 5 times income and it will start to reduce again depending on your overall situation. The same as the income multiples, different lenders have a different way of assessing it. So some are a bit more lenient, some are a bit stricter in terms of how much you can have in terms of a monthly outgoing before it starts to reduce the amount that you can borrow. But it's a combination of those two assessments that will kind of decide how much you can borrow in total.
Yeah, and I'd probably just add in it's the same on both buying and remortgaging.
Yeah.
Just because you remortgage and you can afford your mortgage currently, that they still have to assess affordability if you move to a new lender.
Yeah, if you stay with your existing lender, when you switch rates, they won't do the same assessment, but if you're remortgaging to a new lender, they will do the affordability assessment. I think that's kind of the main info that we wanted to cover today.
Yeah.
Obviously, again, as always, there is more to cover, and it really does depend on your specific circumstances, but hopefully that just gives you a bit of an idea. So again, I suppose one final thing, just a little bit of an example. So is it, providing that you don't have many or any significant outgoings, let's say you don't have too much debt, maybe you don't have loads of childcare, then on the whole, you probably are going to be able to go up to the limit of income multiples, again, depending on the size of the deposit that you've got. But I think 4.5 times income is quite a good place to start.
It's quite a comfortable spot.
Yeah, a lot of lenders will do that, even if you've got, let's say, a smaller, maybe 10% deposit, providing you don't have significant outgoings. A lot of lenders will go to around 4.5 times income. So you can obviously use that to work out a ballpark of how much you might be able to borrow. But if you are really starting to look for properties and you want specifics, then obviously speak to a mortgage professional to actually pinpoint exactly how much you can borrow based on your existing circumstances. Yeah. Happy with that. As always, if you could like the video, subscribe to the channel, and we will see you next time. Thanks a lot.